Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here with Adrian Nicholson, back for another great episode. Adrian, how's your week been?
The week's been awesome, Roshan. Thanks for asking. Looking forward to our podcast today. I'm excited for our topic.
Yeah, this is an interesting one for me because I never actually want to do it, but I actually do find it somewhat helpful and learn some things along the way. We're going to talk about the mid-year market outlook. The reason I must confess I never like to do it is because I'm looking for more actionable items. And one of the things I've learned in my years of experience is that um, directionally trying to predict where the market is going is not something I think is actionable and that can be done. I guess it's a great time to give our disclosure. This is not financial advice. This is merely sharing ideas with you to help you become a better investor, learn from what we learn, and maybe leverage our knowledge. If you need individual advice, please speak to your advisor or reach out to us if you need help. Um, so the reason I say, as I mentioned earlier, there's not actionable items. However, what I have found useful. So, Adrian, next time we discuss covering this and I complain to you, remind me that there is information I get that is useful to just help me think through things overall as a whole, and just some interesting knowledge that I think I'll be able to come back to later.
Yeah, I'd be happy
So,
to do that, Roshan.
yeah, thank you. I appreciate that. Just stop my complaining that next time. But so let's start by looking into this. I did look into multiple sources. The majority was Schwab's mid-year outlook and J.P. Morgan's mid-year outlook, and we break it down into different categories. So let's just start by each category, and we'll go through one. There are no particular order. I think it's just the order that they were discussed in one of the reports, and I just continued with it. But the first is economic expansion. The U.S. economy is in its fifth year of expansion since the pandemic. Consumer spending is still strong, supported by positive real wage growth and real wealth gains. The part that I it's obvious when you think about it, but not so much when you live it. Did you realize it's been 5 years since we've had that pandemic recession?
I mean, yeah, it's hard to think about that, but now that you said it, I mean, that's on the top of mind and what people really need to look at. I mean, I understand why that's an important one too, just economic expansion, because it does feel like not too long ago, though, where the supply chain was a major issue. And that sometimes is the backbone when it comes to global trade. So if all that continues to head in the right direction, which it is compared to how it was a couple of years ago, then that's definitely a positive take right there.
Yeah, it would be a positive. I was just the surprise to me, as I said, obvious if you think about it, but you just don't. Every 5 years seems a lot longer than I would have just if you asked me how long this expansion has been. Um, Next, GDP growth. Now, there's been volatility, and real GDP growth slowed to 1.3% in the first quarter. Um, and quarter two is expected to follow a similar trend. So, a lot of this, what we're going to talk about, is going to be really driven by what's going on with inflation and what's going on with the Fed. But healthy GDP growth gives the Fed the opportunity to delay rate cuts, right? So that's something that the market's been reacting to a lot the last a couple years, really. What the Fed's going to do, I guess that's a constant, but it seems more pronounced right now with we're coming off the fastest rate hikes in history. So strong GDP is definitely a good thing.
Yeah, I mean, I agree, and you're definitely going to see how it varies on a country by country basis. I mean, which ones are continuing to produce, import, just really expand their products and services, and which ones aren't. That's something that investors are really going to have to look on by a case by case basis. And as we know too, what you mentioned, just interest rates and inflation too, is also something that you're going to have to monitor as well, because that just directly impacts companies, the consumers, and a lot of things out there that gets put into or components of the market and the economy.
Yes, yeah, agreed. Continuing on, next category, consumer spending. Um, and it says, despite reduced pandemic savings, consumer spending remains resilient due to sustained wage growth and increased wealth accumulation. This next point is actually where I've been given some homework. It's probably too late for this, but I will put it on my list to research it. But it says significant increase in spending on store brands relative to national brands, and that's expected to continue. That's actually from the Schwab report. So the way I look at this is I've just got to research and see if there is an opportunity in some of the generic brand providers. If it's too late, are they reasonably priced? Are they expensive? I don't have the answers to this because that was not the assignment for this episode. But when I mentioned at the beginning why I don't like it is I don't feel like I have actionable tasks afterwards, and I am then apologizing and taking that back. It's because here's an actionable task. It's definitely something that I'll spend some time on to see if there is an opportunity there. I say sometime because it's one of those things where it could be 5 minutes or it could be 5 weeks. It really depends on when I start pulling on that thread where it goes.
Yeah, I mean, I'm really interested to see where your research had to this. And ultimately, too, a lot of these components and the things that you brought up all impact each other in a way. Because when you think about consumer spending, too, that does play into the inflation and interest rate conversation as well. Because if you think about it, where rates are now, since they're still at a high level, one of the biggest expenses that consumers are facing right now are housing, their mortgages, their rent. That's still at a high level, which really just eats away at people's cash flow, which ultimately makes them have changes in their what they purchase as far as their products and services. So that's also something too that we're where we're seeing we really need to focus on the big macroeconomic indicators and what's going on because that does play a role in the markets and the economy.
Yep, and that is definitely something that's going to come up as we continue through the categories I've got for us. But you are right on looking at these things and thinking them through. So I'm gonna, as I said, I'll share with you what happens when I do my homework looking at these companies. So uh, continue on next. Investment spending, corporate balance sheets, and federal incentives have bolstered investment spending, particularly in AI related technologies, contributing to economic resilience. I mean, no surprises there, correct?
Yeah, I don't think there's any surprises there. I mean, with consumers too, how their spending habits may be changing. I mean, the same goes for businesses and companies out there, and it's definitely going to impact based on size, profitability, whether they're domestic, whether they do most of their business domestically or internationally too. That's going to impact it. Where we have that conversation with GDP, so that's also something that investors need to be mindful of as well when it comes to looking at their portfolio, whether they're invested heavily in individual stocks, just to keep that in the top of mind if there's any risk out there with some of the positions and investments that they own.
Yeah, very true. And you'd mentioned the individual stock uh, piece here, and I'll tell you that's kind of what I look at when I'm looking at this. I would be definitely looking at sectors, trends overall, right? But I am as I'm approaching this, I'm trying to see, hey, can I find an individual company I'd be interested in looking into further as I'm doing this research.
Yeah, I mean, that's a good strategy to just help narrow down your research and save some time. So I agree with you on that.
Next on this labor market, the unemployment rate has edged above 4% from a low of 3.4 in April of 2023, but it remains historically low. Um, and with wage growth decelerating to 4.1% year over year. This next one is what I found pretty interesting. And I'm gonna read it to you just so I don't get any part of it wrong. The Bureau of Labor and Statistics, uh, the establishment and household surveys. It's one is derived by the payroll, that's the establishment, whereas the household surveys, you know, as it says, is from household surveys. So the payroll one suggests that 6.9 million jobs have been created in the last 2 years. However, the household survey suggests that it's half that, about 3.2 million. And the note on this is, for what it's worth, the household survey has tended to be more accurate at important turning points in the cycle in both directions. This is from Schwab's mid-year outlook, and what I found interesting there is just the difference between the two, and then their note at the end that household survey has been more accurate, and maybe the labor market is not as strong as all the data suggesting.
Yeah, I definitely could believe that as well. I mean, you saw it back, I would say, probably in 2021, where they call it the Great Resignation, where people were switching jobs and the job market was strong because there was a lot of stimulus and easing going on. So, and then that really continued up until 2022. And towards the end of that, that's where you started seeing layoffs. I mean, the most notable sector that I've been looking at a lot is just technology, where you're seeing layoffs after layoffs at some of the big, large technology companies as well. So, it definitely varies by sector, where I'm sure there are some other sectors out there that say, hey, we need more people, we need to fill more jobs, and just aren't getting it. And some are starting to retract. Like the example I just used was technology. So that's also something that's important to follow as well, because that's one of the Fed's biggest things that they look at. They look at unemployment, the labor market as well, because keeping interest rates at a high level with companies laying off people could be a recipe for disaster. So that's also something too that, you know, investors would need to be aware of, because that really impacts the economy and the markets.
Yeah, it definitely does. And when you, as you're describing that, it just made me think of what we've done a previous episode where we had talked about, yeah, a rolling recession, right? So if we have that kind of scenario, and I know that's not what you're describing now, but when you talk about the layoffs, that's something that I just thought of, that rolling recession thing, which then makes me think of, the a rolling recovery, so to speak. And what this Schwab report spent some time talking about is, they called it a K-shaped recovery, which means the haves versus the have-nots, essentially, is the way they were putting it. So, yeah, very good point there
Yeah, and I
on the
guess
labor
the
market.
other thing I'd just add to that, and I'm not sure if we'll get into this later, or how, if you saw anything that impacts the labor market as well, is just artificial intelligence. I know that's going to be varied by industry and by sector, but if you just go back to my example, the technology sector, that's something that can AI can significantly impact. Whether or not that's taking people jobs or not, I haven't really looked into it, but that's just a different possibility on how that will impact different sectors as far as their labor market in the future. I think that's on the top of everybody's mind as well.
Yeah, interestingly, like huge opportunities, right? On one end, the opportunity being, anyone that does anything in the AI space can make a lot of money and, relatively easily, I think, find a job in this environment. They're really looking for people in that field. But on the other side, are there people who will lose their jobs or have their jobs replaced because of AI? As we covered on a previous episode, I can't remember the firm's name, but they had AI doing a lot of their customer service, and they said it was the equivalent of like thousands of employees.
Hmm.
So, like those chat bots. So it's it that K-shaped um, economy that Schwab's describing. I think AI is really just a microcosm of what's going on.
Yeah, it's definitely going to be something that you got to research and look a lot into, and just see how that just works its way through the environment in the future.
Next, here's the big one. One of the big ones. It's inflation, right? And because we talk about this, inflation and the Fed sort of driving anything, inflation has moderated with CPI uh, declining, expected to decline from 3.4 in April to 3% by December. Um, and the Fed's target is to get us down to 2. So what I find interesting about these trends is, the Fed doesn't have to wait till it gets to 2 to make their rate cuts, but will they make it when they're at 3, when their target is 2? Doesn't sound like much, 3 versus 2, but 3 is still 1.5 times 2, right? So will they make those cuts if we are at that 3 by December? Will that be enough of a trend for them to feel comfortable?
Yeah, I mean, we've definitely come very far where it comes inflation versus how it was 2 years ago or so. And that's just something too where it's just something that investors really need to be on top of mind of, especially when it comes to their portfolio and their investments, since the market is really being driven by inflation, interest rates, and earnings, and all those can really kind of come together and impact each other. So that's just something too that you have to just be aware of.
Yeah. Yeah, for sure. And with the inflation, I think something else that we've seen and learned is it's not a straight line, right? Which then thinking about investing in the markets, it just leads to more volatility in the markets. The way that it goes. One interesting point to add on inflation before we move on, it says. There's been a plunge in inflation on discretionary items, while inflation on non discretionary items like healthcare, shelter, insurance, those have accelerated by more than 6%. So the expectation is that shelter will trend lower, right? That's what the rate hikes or hoping to do, right? Get a handle on housing costs, but housing costs have gone up with the rate hike. So hopefully that does trend lower. But this is another area I've learned from in here is that the discretionary items have not been inflating to the same rate as non-discretionary items. I just had not dug into the data deep enough or really thought about it to find to see that difference.
Yeah, that is interesting.
Yeah, even uh, earlier, Adrian, when we talked about the rolling recession, that reminds me on a previous episode when things were crashing and we were talking about will we fall into a recession and so on, going back a couple years, and there was one thing that said it wasn't a recession for the rich, right? That basically the rich were immune to it, and back then all discretionary items were still selling rapidly. Expensive properties, everything expensive they'd be really wealthy to afford was still moving. So I was just surprised to see that from an inflation perspective that hasn't been the opposite, which is why it's been so painful for so many people out there, right? Food prices have gone up um, significantly. Healthcare, shelter, all the things that I mentioned earlier. But it's, as the category says, it's non-discretionary. It's things you need to live that have gone up so significantly.
Yeah, I know the consumer balance sheet right now is just something that has just been experiencing some just major fluctuations if you think about it for over the past 5 years, and that definitely is important when you look at the overall picture and just seeing how we talk about like rolling recession, just different pockets and different industries doing well or not. I mean, I think the market is a good representation of what you're seeing, how it's still sort of a narrow rally that you're seeing. The broadening that everybody really predicting really hasn't taken the full effect that people were expecting. And that's just shown with some of these economic indicators and what we're talking about, how there are some experiencing strong gains, strong experiencing rises, where some aren't and still have a long ways to go to get back to those levels that they were at previously a couple of years ago.
Yeah, and that point I made earlier of the generic brands, and that makes sense, right? It's logical, right? That things are becoming more expensive. Why not go with the generic brand?
Yeah, I definitely agree with that, Roshan.
Next, Federal Reserve and policy. This is what the markets really have been looking at and reacting to with overall. What do they think the Fed will do? And overall, inflation uh, has slowed, but it hasn't gotten to where the Fed wants. And yeah, what people are thinking, at the beginning of the year, multiple rate cuts are likely. Uh, Schwab's opinion on this is there are still going to be 1 to 2 rate cuts coming up, and one of the Fed board members, Neil Kashkari, came out earlier, probably a week ago, and he said it's reasonable to think that there would be a rate cut, excuse me, this year. So I think things are still lining up. But do you remember at the beginning of the year, Adrian, there were people calling for 6 cuts
Yeah, I
this year?
definitely remember that. And I mean, ultimately, if you think about how far we've come, how the market and the economy, I mean, it's definitely not great. There are still some areas that we talked about have weaknesses that still need to catch up, but it just really just shows you how resilient the economy and the markets can be and individuals can be, which has helped. Inflation has gotten under control where we won't need those rate cuts as much as we thought we did a couple years ago. And yes, inflation is not where we are at, but also I'm not really sure how to describe this though. A certain level of inflation is healthy though for certain markets
Yes.
and the economy.
Yeah, and I always think of when we talk about something like this, but inflation versus deflation. I think of Bernanke, Ben Bernanke, and they called him Helicopter Ben because he had said if there was deflation, he would drop money out of helicopters. Right, just illustrating how bad deflation is. So inflation is good. We just don't want too much of it, and
Yes.
it got too hot for a minute, and the Fed had to do those hikes. But things have definitely moderated and stabilized. But this inflation conversation, specifically when we talk about the people predicting six cuts, why, and now we're sitting in June with no cuts and saying maybe one or two. That's why these market outlook conversations, why I'm always hesitant. As I said, just because I don't believe that anyone can predict it accurately, right? So then is the outlook a waste of time? But once again, where I do find value is looking into the data and the information. The last category is mainly from the Schwab mid-year outlook, where they're looking at is just what they think is going to happen with the stock market, right? So this was a few interesting things in here. Um, but stable treasury yields should be supportive of the market, but a sharper move in either higher, driven by inflation, or lower, driven by weaker economic growth, would likely lead to weaker performance and or higher volatility. In other words, a Goldilocks scenario would continue to be supportive, but the likelihood of that persisting is diminishing. Now, I'm going to just give a little more color on this. But basically, what they're saying is, um, if if rates are cut, it's either because it's likely because or if there's a change in rates, really, right? They're actually saying a scenario that I've essentially put out of my head is that there are more rate hikes, but they're saying a higher move with a rate hike driven by inflation picking back up, which I think is unlikely, would lead to a declining market. No surprise there, because that's what we lived through the last couple of years. But then they're saying rate cuts driven by a weaker economy would also lead to a weaker market performance. Any thoughts on that, Adrian? Before I want to dig a little deeper here.
No, I mean, I think that's a great point, and I'll just really just break down in just three different categories: just stocks, bonds, and cash. And I think that's where mid-year outlooks really are helpful for the investor out there because it really just makes them look at, hey, what's my portfolio look like? What's my weight towards equities, bonds, and cash? And it's hard to predict what's going to happen in the future, but it just gives me an idea if I need to make any changes or just put any strategies or principles in place just moving forward, where you talked about stocks. And we mentioned before the narrow or broadening out of the rally. If that's the take, then if you're not really exposed to those few select companies, you might not see the returns that you expected. If the broadening out happens, then you might experience it. But if the market goes down, whatever your exposure is to equities, is that something that you really need to consider if that's how much risk you want to take on. And then when it comes to bonds, just short term versus long term is just an easy conversation to have where that is really driven by whether rates get cut a lot or not. Because if you're in short term bonds, I mean, you're really experiencing some strong yield, but maybe those days are numbered and that might not happen. And then the last one I mentioned, cash, money market accounts as well, where people have been getting paid where they haven't been used to. If you pull back the current 5 years ago, maybe that time is ending or maybe not. And that's something that you really need to look at when it comes to your overall allocation.
Yeah, and you talk about short-term bonds, right? Like when you talk about bonds and those rates, short-term and long-term bonds and what your mix is there is definitely makes a difference as well.
Hmm.
Um, my view on this is a little bit different with what Schwab is saying, because to me, the way I'm reading this is they're like 2 out of 3 scenarios are bad, and the one we're in, the Goldilocks scenario, is the only good one. Well, uh, so going back to their scenarios, I don't think higher rates are going to happen. Right, nothing's impossible, but I think it's highly unlikely that there are any rate hikes. So I'm throwing that scenario out. Second is the scenario on lower rates driven by a weakening economy. I do think a weakening economy would have a negative impact on the market. So in there, I'm in agreement with that. But I do think there's another scenario that's not just their Goldilocks scenario, but it's that the Fed can cut rates when things just stabilize where they want them to, and that the Fed, I believe, has driven rates higher than we need to in a normal environment, right? So I think that where we were before was not a normal environment. By before, I'm saying before they started raising rates, when we were looking at zero rates. That's not normal. But I think where we are right now is above what the US economy needs to be as well. So I think they've got room to cut rates without a weakening economy. And I think that they're going to have to cut rates before the economy weakens, because though they're going to stay higher for longer, no disagreements or arguments there. They've said it, and it makes sense until we get consistent decline on inflation. I think they're going to have to cut rates on the data as opposed to cut rates after inflation gets there, which, to the point that I made earlier, where the projections are, the Fed wants us to get to 2, but they think we'll be at 3 in December. I think that 3 may be enough of a trend to get them to actually cut. I don't think they have the luxury to wait till 2, because I think that will potentially drive us to a weakening economy. So, a little bit of a different perspective on there. I'd say it's a nuance different. I'm on board with one of their scenarios, and I think they're just minimizing the third scenario by calling it the Goldilocks scenario.
Yeah, I mean, there's nothing much I really can add to it. I mean, the only thing I guess I will mention, which we talked about again, is just the labor market. I feel like, in a way, even though the labor market hasn't been great, it's been strong enough that it really helped the Fed, where they said, hey, we can keep rates a lot higher because unemployment is not getting out of control. And that's something, too, I feel like on a quarter by quarter basis, is something that they really need to stay on top of, because that's something that could just be as hard to fix than inflation was in bringing that down.
Yeah, and uh, they definitely need to be cautious with what they're doing. Like, they're a lot in this camp. I'm in one of them that said they waited too long to raise rates, right? And I don't think they want to make that same mistake twice in terms of waiting too long to cut them.
Yeah, I mean, I agree with that. I mean, that's something too that we're just going to have to see what happens and how it really just impacts all these different type of companies out there as well, because that's one thing too that you really haven't seen come back into the market that you saw that was big in 2019, which was mergers and acquisition, the IPO market. I mean, that's something too where that benefits from lower rates because there's easier liquidity, deals are made as well. So that's something too that an environment that, or a sector that really hasn't come back to where it used to be a couple of years ago.
Yeah, and but you know what, we are seeing it went from sort of nothing to we are seeing things happening now, right?
Yes.
And we have for the year. So, but yes, not up to where it was. Next interesting point, once again, where this could be actionable. It's more research. So once again, our disclosure: this is not investment advice. Reach out to us if you need some help. Contact your financial advisor. Um, if you'd like to look into this. But Schwab said, given the potential for volatility, we suggest focusing on companies with high quality attributes such as strong profit margins, upward revisions in earnings estimates, a high interest coverage ratio. These companies may be better positioned to weather the potential ups and downs. No surprises there, right? If you are expecting, they're saying there's potential volatility. If you're concerned about the volatility, high quality companies are the way to go. I don't think I'd argue that in any environment, even if you're not expecting volatility.
Yeah, I mean,
Your
just
sense
looking
of
at
that.
balance sheets, and especially with higher rates too, definitely favor the companies that have strong balance sheets, cash on hand, and just their overall fundamentals look strong. And like I said, and like you mentioned too, that's really beneficial in any type of markets. But I guess that's too just if rates change, maybe that thesis will also change.
Yeah, that may change over time. Um, Next on here, interesting one. Due to elections, markets could respond negatively to the outlook of rising tariffs and trade friction that might potentially boost inflation and weigh on exports.
Yeah, I mean that's another interesting one too because I mean that really makes me think all the way back till 2019 when we were having the tariff wars with China. I mean that was every investor was really looking at that and considering how that can impact them. And then 2020 happened, and then the narrative really changed, and a lot of that has been pretty much out the door. And now that we're coming up to election, that's going to be another just topic of discussion, which also just brings uncertainty as well, which we know markets don't like.
Yeah. Next on here, the Magnificent Seven is not dominating performance anymore. Now, instead of the Magnificent Seven, they're saying it should be the Fab Four. Those names are Amazon, Meta, Microsoft, and Nvidia. So, uh, do your homework, do your research. This isn't advice, but that's Schwab's take on it, and they've got some performance data to back that up. Performance as in what the companies have done.
Yeah, I mean, though that to me just seems like it always just changed on a quarter by quarter basis or a year by year basis. I mean, not too long ago we had Fang, now it's the Magnificent Seven, now it's the Fab Four, if that's what they are starting to call it too. So, I
Yeah.
mean, that still just plays into just tech heavy, also just a few companies just moving the market as well. Where maybe if you can find deals anywhere somewhere else, that could be a good opportunity.
This is the last one. Interesting, and this is something that I'm planning on us doing an episode on in the future when I do more homework on it. But it's small cap versus large cap, and this actually to me was one of the most valuable parts of the research here. So it's highly unusual to see small caps lagging in the early stages of the bull market, but this is not a normal cycle. And this is once again from that Schwab report. We think higher rates are putting more pressure on small companies' profitability, driving the performance gap. Since almost 40% of the Russell 2000 consist of companies that with no earnings, it makes sense as to why forward earning estimates are trending lower for the index. Not only that, but for large companies that termed out their debt before rates spiked, the Fed's rate hike has been harmless, evidenced by the near 2 decade low in corporate net interest payments. Our sense is that small versus large cap performance gap doesn't meaningfully close until the volatility subsides meaningfully and or the Fed starts easing. So why I find this so interesting. Actually, Adrian, why don't you share any thoughts you have on this first, and then I'll go second.
Well, it makes sense why that one is also too just impacted by rates as well, where these large companies can pretty much weather those storms, depending on the balance sheet too. Because I'm sure large cap companies that are highly leveraged as well aren't really big fans of higher rates, but they definitely can weather the storm, just really capitalize on whatever they can because they're so big compared to smaller companies that sometimes really do rely on easy liquidity and capital that can really help them expand and apply more to research and development, which can help them grow more and just compete with their current competitors out there.
Yeah, and I'll tell you why I found this so interesting. Just a different thing to add on what you said. First is that if you look at the data, small caps, the gap between small cap and large cap is the greatest it's been since the tech bubble. And I'm gonna use my memory to best guess the repeat the data. We did have this in our actually beginning of the year, our market outlook. So please check that episode out if you want the exact facts behind it or exact numbers. But I believe it was since the tech bubble, there's been a gap, and I believe small cap then outperformed for about 9 to 10 years. Um, Now, why I find this information so valuable is really the last point that until interest rates, and they say until rate volatility subsides meaningfully or the Fed starts easing. I think it's really when the Fed starts easing, but they're saying this gap won't start to close until the Fed starts easing rates. So why I find this so interesting is because I think what they're saying makes perfect sense, and I think this shows the point on acting based on past data alone versus based on what you're expecting going forward, right? So the past data being the fact that there's the biggest gap we've had, right? Or biggest gap since the tech bubble between small and large cap. But then thinking forward being, well, what's actually going to change that gap? It's not going to change just because the gap exists, right? It'll change when something happens. And for me, it's when the Fed starts cutting rates, or you could argue when the expectation returns that we'll start getting multiple rate cuts. But to be safe, maybe you wait until the Fed actually begins the rate cutting process. Remember last time it was like a 9-year outperformance or 10-year outperformance. So if you miss some of the early stage, there should be plenty of time to catch up. Once again, not investment advice, just thinking through some of the data and some of the thoughts that we have on the mid-year market outlook. Adrian, do you have anything to add at all?
I guess the only thing I'll add to that small and large cap debate again is, I mean, I feel like the toughest decision out there for investors is how they want to invest in that space, whether it's an exchange trade fund, mutual fund, individual stocks. The research definitely is going to be something that it's going to be time consuming and tough to do, especially with individual stock too, because, you know, some might not have as much data out there towards a large one, depending on what their sector is as well as maybe, or the industry they're in as well as something too that you have to look at, where if there's not a broadening out, especially within small caps, you know, whatever sector or industry you're in, you could be subject to either great performance or just a tough environment as well. So that's something too where you really need to think about if you want to really go on that journey.
Yeah, definitely a lot to consider, not only in that point, but I think with everything that we covered today in general with the outlook, the markets, economy, etc. And I think we've given a lot of homework to everyone listening and a lot for ourselves to look into. But we'll please join us next week for another great episode. Take control and achieve your goals.
Schedule a conversation with Roshan, Adrian, or Eric today at retirementlifestyleshow.com. Roshan and Eric are certified financial planner practitioners. They, along with Adrian, are investment advisor representatives and serve clients across the U.S. with financial planning and investment advice through Arete Wealth. If you found this show helpful, gained knowledge, or enjoyed the time you spent with us, tell your friends and leave us a 5-star review. This will help others discover the show. To access our show notes, to download any of the tools mentioned in today's podcast, to ask us a question, or to schedule a conversation, go to retirementlifestyleshow.com. All opinions expressed by podcast hosts and guests are solely their own. While based on information they believe is reliable, neither Arete Wealth nor its affiliates warrants its completeness or accuracy, nor do their opinions reflect the opinion of Arete Wealth. This podcast is for general informational purposes only and should not be regarded as specific advice or recommendations for any individual. Before making any decisions, consult a professional. The show hosts offer investment advice through Arete Wealth Advisors, LLC, an SEC-registered investment advisor, and securities through Arete Wealth Management, LLC, member FINRA, SIPC, and NFA. Finally, our music is The Chance by Jason Shaw and Audionautics. It's part of the YouTube audio library, and it's licensed under a Creative Commons license. I am Ray Voices. Thank you for listening.